Hello, it's Ben Hockema. I'm founder and advisor at Illuminate Wealth Management, and we are here today to talk about the investment review and outlook for 2026. So we're going to look at 2025 and look ahead as we are building portfolios and going into 2026. Today is Wednesday, February 4th, and a lot of the numbers you're going to see are as of December 31st or through the end of January 26th. So we'll talk about that as we go through each one. Let's jump right in, and I will share my screen, and we're going to go through our outlook. So, um, where we're starting here, first topic is just review 2025. Then we're going to go through and look at the mid-year predictions that were in our mid-year outlook back in July, and just see how we did and give ourselves a grade. Then go through 2026 changes. What are the changes to the capital market assumptions? I'll explain what that means as well. Then just a quick little primer on risk management in portfolios, how we approach managing risk and what that actually means to me. And then the last thing is just what do we actually do? So number one, as we go to headlines, you can see um, first one, I think we all remember back in March and April was all about tariffs and really was the first half of the year and continues to be a headline now. We had a shock that happened really Liberation Day. Markets were down over that period of time about 10%. And then on the day that things were reversed, then we had about a 7% increase, I think, in the S&P 500. So lots of volatility around tariffs. Another big headline for 2025 was just AI fueled highs. So AI has continued to be a big story in the markets as we move forward. That'll be interesting to see how that plays out. And it is something that when we get to the last couple of slides, we'll talk about just reducing our exposure to tech heavy, AI heavy trades, and we'll talk about that. Another big one is gold and silver hitting new highs and just continue to go up and up and up. That has been a story really for a couple of years, but I had a lot of questions. We've obviously had gold in client portfolios for I think 4 years now, and one big piece is just when is that going to stop? And as we look at it, commodity cycles tend to be 15 to 20 years instead of your normal 5 to 7. And so, yes, we could have some volatility in gold and silver, but that doesn't mean they have to crash. And then the last one is global markets for the first time in a while really outperformed US markets. And so that was both on a currency hedged way and then just local currency on the way that actually worked. And so companies internationally have some nice opportunities there, and you're starting to see that pay off. So what actually happened? If we go to performance, we have I'll just kind of walk through the different ones. So this is full year 2025. Gold was up 64% approximately. Then we have the all world ex-US. So this is basically developed international and emerging markets was up 32%. I also separated out emerging markets. So VWO is just emerging markets up almost 26%. Then we have a broad real asset fund that owns a lot of different types of real assets. That was up 20%. VTI, the next one, up 17%. That is your total US stock market. So it's basically just owning all the US stocks in a cap weighted way. Then we have bonds. Bonds had some decent returns. First time in a while that we've seen that up 7% for the year. And then I threw in here also the dollar. We talk about the dollar a lot in these videos just because as the dollar changes, I think a lot of people don't understand how that feeds to other parts of the market. So it's something that we watch, and the dollar being down 9% definitely matters. That is part of why international stocks outperformed. You can basically say, okay, it's not exactly this way, but you could say, okay, 9% of the difference between VTI and VEU is probably just because the dollar is worth less. And then the difference is really just in local currency. It's a good back of the envelope way to look at it. So overall, really strong markets, great to be invested overall. And depending on where you invested, you feel good or you feel really good on portfolios. So now I want to revisit the things that we talked about in our mid-year outlook. So this was recorded on July 28th. And so a lot of the numbers, the charts I'm going to show are on there. Before I go to the next slide, let me remind you what the purpose of these projections. It's not actually about being exactly right. That is not what the goal. If you go back to that video, that I was very clear on that. What we more want to do is say, okay, this is our base case. This is what we expect to happen in a normal scenario. And then if things deviate from that, that's instructive on, okay, what were our assumptions that were incorrect? What are some things that need to change? Maybe we're not on a base case. Why would that be? And how do we adjust from there? So it's useful for us to go through these projections and predictions, not because we're trying to be right every single time, but more on directionally where are we going. So first one, I said at the time, we think gold's going to approach 4,000 before year end. I'm going to give myself a nice win on this one. However, I could see an argument to say I was wrong because I undershot by a lot. So gold ended the year with the peak around 4,600. So quite a bit higher. And then this is just showing the chart from January 1st all the way to now. So actually today or at the end of January was at 4,900. So, crossed the 5,000 mark, got way up there, has dropped down a little bit here in February. But overall, just definitely a win on that one. And at the time, if you go back, a lot of people were saying gold had to crash. It's going to go below, 3,000. It was at the time, it's right in this range here. If you could see the cursor, so around 3,300 is about where it was at the time. So that was a pretty big increase from there. Number two, I said I expected energy stocks to outperform the overall market for the rest of the year. So this is looking from the date we recorded that to the end of December. And you can see VTI, the total market, outperformed XLE, the energy. I'm going to give myself half of a point here because of this next slide. If I expand out and include January, so same period of time and then include January, energy stocks were up 18%. So you can see, obviously, January is great time for energy stocks. And so comparing those two, again, what's the point of this? It's directionally, where do we think things are? Energy stocks have been out of favor for a number of years. We've stayed invested. We believe that there's still opportunities there, even after this nice returns here in the last month or so. And so I'm going to give myself half a point for that. You can decide on your grading for me when we get to the end. Then we talked about international stocks. They had outperformed the first half of the year, and I argued that they would continue, and that was true. So international stocks were up 11% through the end of the year for the second half, and then VTI was up 7.5%. So that has continued, and I expect that to continue here in 2026. Then we also said U.S. bonds will deliver positive total returns for 2025. We already touched on this. The green line there, B and D, is bonds, just so bonds were up 7%. And again, I'd like to compare to different pieces. So we've got VTI that's there at 17. And then the biggest thing that I was wrong on, just directly wrong, was that U.S. stocks would do better in the fourth quarter than the third quarter. And if you go back to that video, the expectation that I had at that time was that the third quarter would actually be pretty weak. And you'd had a nice return in July. You can see this line going up here. July 28th, the end of July is here. And so you had some nice returns already. And then there was a drop. And, at this point, I looked like I was going to be right. And then just kept going up and to the right. And the point of this exercise is to say what was wrong. I expected the third quarter to be weak and that the fourth quarter would recover. We didn't have the weakness in the third quarter, and so fourth quarter was fine. This is the third quarter up 8%, fourth quarter is up 2%, but that's not really anything to write home about. And really, it's because you didn't have the losses in the third quarter that I expected. So that was wrong, and that's an interesting thing to look at. We look at seasonal patterns, we look at valuations, we look at short-term movements, and try to make the best decisions that we can. We know we're not going to be right every time. Now, if you go back and look at trades that we placed for your portfolios, we didn't sell in advance of the third quarter or anything like that. We're not using this for trading purposes, but it's more directional and, again, have some assumptions here. So this was definitely a miss on this one. And then the last one is I predicted that IPO activity would pick up significantly for the year, and that absolutely happened. So global IPO market stabilized in 25, and 26 continues to look strong. Third quarter of 2025 was the most active quarter for IPOs since 2021, and 54% increase from the year before. That is activity that you hope and really expect in a bull market. When things are going up, when the market's going up, we expect more and more companies to go public through an IPO. And so that is a sign of a healthy market. When IPO activity falls off, that is a sign that things are not good overall in the economy. So that's a really good sign. Now let's talk about the capital market assumptions. So what even is a capital market assumption? We every year in the fourth quarter, we take a look at every single asset class that you can buy, different areas of the U.S. stock market, international stocks, real estate, alternatives, anything that you can think of to possibly buy as an investment. We look at and we do a 10-year outlook. So we do this every single year, and so it does change, and it's interesting to see how that changes year over year. Part of it changes just what happened in the year. If things have done really well, then all else being equal, we'd expect future returns to be lower. But also, what are the other inputs that are in there? So what's the inflation assumption? What's the growth of the economy assumption that we have? And what we're trying to accomplish here is have a baseline, and then we have volatility around that. And then we build the portfolios from a top-down approach. We have the asset allocation, and so we say, okay, we think you should have this much in U.S. stocks, this much in U.S. small cap stocks, this much in international stocks. And then once we've decided that, then we take it down from there and say, okay, of those different asset classes, how do we allocate into different mutual funds and ETFs? What is the product that we're going to use to capture those returns that we have? But it all builds off of this capital market assumption. So as we are taking that, let's look through some of the changes in the key areas. So we separate into three: fixed income, and we want to optimize within fixed income. Then we have equities, want to optimize within stocks. And then we have real assets and alternatives, optimize in that area. So what you're looking at here in the light blue in 2020 is 2025 assumption. So before we went into the year. And then today, what's our assumptions today for fixed income in different areas? So total U.S. bonds, we have TIPS bonds, which are Treasury inflation protected securities. We have dynamic bonds, high yield bonds, and muni bonds, and then muni high yield. So as you can see, almost everywhere except for muni high yield, we are expecting lower returns going forward than in bonds than we had before. That makes perfect sense to me. Just if we hadn't done the math, I would say, well, bonds are up 7%. That's above the interest rate that we had, which means bond interest rates dropped and future returns will be lower. So when interest rates go lower, you earn return in that 1 year, but future returns are going to be at that interest rate. That's the best proxy for bonds. So this makes sense. Bonds are going to pay a little bit less. And let's keep this in mind. So we're about 4.5 is our expectation for U.S. bonds per year over the next decade. Then we go to global equities. So U.S. all cap is just about 5% is what we expect. International developed, we expect to do better than what we projected before, almost 8%. And then emerging markets above the 8% mark, about the same as what it was. So big change here of just dropping a little bit on U.S. all cap moving forward and increasing developed equity, international developed. And so that's going to definitely play out when we get to the portfolio changes, because this is what drives our optimization within your portfolios. But I mentioned before that, let me go back, the U.S. bond number here is 4.5. U.S. stocks is a little over 5%. So think about that from a risk perspective. How much do you want to have in U.S. stocks compared to U.S. bonds if you're trying to manage risk in the portfolio? So we'll talk about that when we get to the risk management slides. And then real assets and alternatives. So as we're looking at these numbers, I just want to say one big thing to keep in mind is these are broad categories, and that's even for the stocks and the bonds as well. Within each of those, then it's our job to find the best investments that we can in those. But this is just basically saying overall for the allocation, how do we expect different areas to work? So we have real estate is up a little bit, broad real assets is pretty flat, marketable alternatives is down slightly, and private equity down slightly. But all these, you look across the board, all above that 6% mark. That's a key number, especially when we're comparing to stocks and bonds. So, as I've mentioned multiple times, let's talk about risk management in portfolios. So, when I say risk management, there are two main risks that we're looking to manage. So, the first one is the one everyone talks about, and that is that losses matter. That is to protect losing money. And so, I always like to talk about this with clients of just this is just math on the way that it works. So, if your portfolio loses 10%, you need to earn not 10% to get back to even. You need to earn 11.1%. And so if you lose 10, you got to earn 11. If you lose 20, you have to earn 25% to get back to where you were. And if you lose 40%, you have to earn two-thirds, 66.7. Again, just to be even overall. And so if we can, as we're approaching portfolios, limit the losses that are really big, you don't have to make as much on the upside to make money in aggregate. And so we're trying to manage through an entire market cycle. And so part of that job is protect you on the downside. And but there is another risk that's out there that a lot of people don't really talk about, and that is inflation matters too. And so I just wanted to compare and just put this out there for you. At 3% inflation is the first column, 4% inflation. What happens to $10,000? What do you need to have? What's your portfolio need to grow to just to again break even on purchasing power? So if inflation's 4%, 10 years from now, you need 14,802 just to buy the same things you bought 10 years earlier. And so you see how the differences compound over time. And we're only talking 1% difference, 3% versus 4. And so you look out 30 years, we're long-term investors, and that's a big difference, but just at 3% versus 4%. And so as what does this mean for portfolio management? We don't want to be so short-sighted and worry about losses and forget the fact that we're building for decades for most of our clients. And even if, I know some watching this are older clients, we're also building for, inheritance to your heirs and things like that. And so we're talking real decades here that we want to make sure this money lasts and grows. If you only earn 4% on your portfolio, yeah, 10,000 will grow to 32,000, but you're not any better off than you were before. So we have to beat inflation and we have to protect you on the downside. And so as we're talking about these portfolio changes, both of those are in mind as we're putting that in place. So on these portfolio updates, here's the main thing. Number one, adding to developed international and reduce, and that's mostly coming out of U.S. large cap tech stocks. That's the tweak. That does not mean completely selling out. It's just on the margins, adding a little bit more developed international, a little bit less in U.S. tech, in U.S. overall, but mostly tech. Then we are also adding a lot to marketable alternatives. So when I look at those bond numbers, bonds earning 4.5%, not super exciting to me. If inflation's running 3 to 4%, then you're barely keeping up with inflation. And so when I look at it, I say, okay, how can we protect on the downside while also earning a little bit better return? And that's where marketable alternatives come in. So we expect that to earn a lot more money. And what marketable alternatives are, there's a lot of different ways to describe them, but it's basically things that are moving in an uncorrelated way to stocks and bonds. So they're going to move independent. Very clearly, that does not mean they're moving opposite. What that means is there's very little information you get. If I tell you stocks are up 10% this year, you're not going to know how marketable alternatives did. They could be up, they could be down. And so that is valuable from a risk management, protect you on the downside perspective. Because if I can throw in a couple different marketable alternatives that you have that are going to move independent of everything else, then you've added the big word diversification and you're able to protect against the downside, but still have a little bit better upside. And so adding to that, basically doubling what we had. And so as you look in your portfolio, depending on your specific situation, the type of accounts that you have, your time horizon, we have a couple different ways that we do it. So it could be a couple of mutual funds that we have, a long short equity fund, and a diversifying strategies fund. Another option is outside. We do have some clients with hedge funds and long short separately managed accounts. And so one of those, we're adding more to those areas and then taking that into account. Some of that is coming out of core fixed income. So that goes to the next one. So when bonds are worth less, or we expect them to earn less, then we're going to decrease it. And then we do think dynamic bonds provides a nice alternative. And so that doesn't mean we're taking a bunch of money out of fixed income. Part of this is going to alternatives, but part of it's going to dynamic. Dynamic bonds basically are it's a global bond fund that has more ability to move to different types of markets. So it can own US, it can own inflation protected securities, it can own international bonds. You can go different parts of the yield curve, different types of bonds. So we like the dynamic nature of that, especially as interest rates have started to fall, and that could continue. And then I want to talk very briefly about critical metals. So we have already, for most of our clients, we have exposure to traditional energy stocks, but also uranium stocks, because as we look ahead, we believe that nuclear power needs to be a part of adding more. But as we look to the overall energy market, and you look at how much is being taken by data centers, what's projected moving forward, how much of the grid is going to be used, even by 2030, I think it's something like 16% of all energy consumed in the US is going to be for data centers, mostly AI driven. And that's just the baseline projection. I've seen some numbers that are significantly higher that, by 2035, half of energy used is going to be used by data centers. Regardless, the way that our energy infrastructure is today, there's no way to keep up with the demand. And so as we look at it, there's going to be a build out of more and more energy production. And that's not just going to be nuclear. Nuclear is going to be a part of it, but it's also going to be things like solar and hydroelectric and geothermal and wind, all the different areas that you can get access to it. And some traditional, probably dirty coal and things like that will probably be a part of it too, because we have to. And so as you look at that across the whole spectrum, we want to make sure you're well positioned. And so we are diversifying within those critical materials to reduce a little bit the uranium, just because we don't want to bet just on solar or sorry, on nuclear. We want to diversify to all those. And so we have added a critical materials fund, which is outside of it does have some uranium, but it also has things like nickel and copper and lithium and different metals that are needed for all those different energy infrastructure. So I've got a lot of other things I could talk about on that. It's something that I'm excited about because I think that that's a nice value add to the portfolios that are needed, and then will help you, hopefully get some returns as I expect. If energy costs go up, inflation goes up, that should be a nice hedge against that as well. And then we want to maintain what we currently have in real assets and energy stocks. So we own broad real asset funds, which own all the different areas that you can have, including real estate. But we don't have a dedicated real estate fund for most of our clients. But we want to maintain those exposures, and then traditional energy stocks. And as you saw in those earlier slides, we've had it for a while. It's starting to pay off. Let's keep that train going. And so in conclusion, there's a lot of words that I just said and not, I would say, wholesale changes. And that's key. Unless we have extreme environments, we are not trying to rock the boat. We're not trying to predict with certainty that you should sell everything in U.S. stocks and buy everything in international stocks. That's not happening. Even if I believe international stocks will outperform, there's probabilities there. There's a possibility it doesn't work. There's also the reality of we are trying to manage long-term portfolios. We're not going to let short-term moves decide it. And so we take risk management into account. We absolutely want to make sure that you're protected both in the short term, but also long-term purchasing power that continues to build on there. And we want to look outside of just traditional markets with the market alternatives, the energy stocks, the critical materials, all those different pieces, I think are key in additions to the portfolio. But you're still going to be driven by the same principles of compounding, stay invested, don't pay taxes if we can avoid it, and let your portfolio do the work. And don't go and just make wholesale changes because you're worried about what's going on in the world or the US or something like that. We want to make sure we're long-term investors. So in conclusion, we've already actually made most of these changes that I'm recommending. You can look at your portfolios, see how things have changed. We're adding this over time, making some additions, obviously tracking what's going on and ongoing rebalancing. If we continue to have volatility, we've had some in the last couple of weeks. If that continues, that will just present some additional opportunities for rebalancing and opportunities to buy low, hopefully in some of these different areas that I'm excited about. So thanks for taking time to watch this. And here's our wonderful disclaimer that we have here. With that, this has been great. And hopefully, if you have any questions, you reach out and we'll do another one of these videos here in 2, 3 months. So take care.